Hello there. Welcome to Alternative Investing. I'm Andrew Bell. Here with me, my regular Friday co-host, David Kaufman, president of Westcourt Capital. Great to have you here.
Excited to be here.
You always brighten up our Fridays.
Excellent.
On this show, we look beyond the traditional realm of stocks and bonds, explore some of the alternative ways you can expand your portfolio. On today's show, we're talking about options and futures trading. Give us the definitions, David. Options, what are they?
Okay, let's walk through these, and I think we actually have a board that we can read along with. So let's start with the definition of an option. So an option is the right, but not the obligation, to buy or sell a specific amount of a given security at a specific price during a specific period of time. I mean, there's a lot of things, though. We see this on the screen now. There's a number of different variables. And as we can see, they can be used to effectively go long or short, depending on whether someone has a bullish or a bearish attitude, or whether they're trying to use it as a directional bet versus a kind of a hedged bet, which we'll get into, of course, later in the show. So that's how options work.
And just to sort of clarify, say I'm bullish on RIM, but I don't want to put up all the capital to buy 1,000 shares.
Right.
I can put up far less, buy an option, a call option. It'll give me a call on the stock if it gets to that price.
Precisely. You can buy a call option. You pay a premium today with the hope that it goes up in value, and it's got internal leverage, so that you're actually controlling thousands of dollars of RIM shares in this example for a lot less than if you had to go long the stock. The nice thing also, the most you're going to lose in that example is the price of the option.
So it has so-called premium.
The premium. So it has a limited downside and an unlimited upside. And so if you buy an out of the money option, meaning you're bullish on it, if it's a call option, you can stand to make an enormous profit.
An out-of-the-money option being a currently worthless option. For example, giving you the right to buy RIM at $100. That's worthless until RIM gets to $100.
Yeah, if it's at the money, then it would be different.
Futures.
Yes, so we have the definition here for a future, which is a financial contract, which is an obligation rather than a right, so it's for the future. Obligating the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or a financial instrument, at a predetermined future date and price. And so, as we see here, futures trading, as is options trading, is a zero-sum game. There's always a winner and a loser, but it's very important to understand that, unlike with options, that if you're just buying options, you have a limited downside, that when you are in the futures game, you have an unlimited downside. So that the wins and losses are symmetrical, but they can be enormous. And that's very important to understand when if you're thinking about getting into the world of futures.
Now, we've got an expert guest coming up, but these two terms are going to come up. Let's start with the first one, mean reversion. What's that all about?
Right. Well, mean reversion, actually, which ties into the concept of convergence trading, some people refer to it as relative value. It starts with trying to identify mispriced assets, usually using derivatives. And so what happens is that you use a quantitative approach. Often they have a black box, which we've talked about on this show in the past, to try and find out whether the implied volatility in an option or a future would be mispriced. So that if you were to find, for example, two options that were similar but mispriced, you would end up trying to, like you would with any other security, buy the cheap one, the underpriced volatility.
And sell the overpriced one.
Exactly, and sell the overpriced one. And then what you would have to do, in theory, is just sit back and wait for convergence, which is why they refer to this as convergence trading.
And obviously we've got this incredible volatility, the tragedy in Japan, the turmoil in the Mideast, and so we're seeing big moves in something like oil, options on oil stocks. You'd be looking for inefficiencies there.
Exactly. So that at times like these, when you will have, no doubt, you'll have volatility instantly, and then some people will believe that volatility will continue. Other people will think that it'll be short-term volatility and try and profit, as tragic as the events are, try and profit from the fact that the world is sort of turned upside down for a moment in time, and they may believe that it may not last. So you can be short volatility, you can be long volatility. And I wanted to bring up the example of long-term capital management, which we've discussed
in the late 90s. It was the giant hedge fund that basically got bailed out by the Fed.
It ended up getting bailed out by the Fed and banks.
Yeah.
And it was put together by a bunch of PhDs, including Canada's own Myron Scholes, who won the Nobel Prize in economics. And so they all got together, super smart. They put together their black boxes. They did everything that they're supposed to do, identify the cheap assets, identify the expensive assets, buy, sell, and then wait for the convergence to happen. But guess what? divergence happen. That the events in the world, like the Russian debt crisis, caused a divergence and the mispricing to not only not contract but expand.
Basically, everything went down for a while.
Well, it went in the wrong direction for a while.
Okay.
And so that what happens is that your best friend in normal times would be your prime broker who gives you plenty of leverage to go and place enormous bets. And if you're wrong, that same prime broker can become your worst enemy if they decide to give you a margin call. And that's exactly what happened. And if you do not have enough dry powder to satisfy a margin call in the event that you're wrong in the short and medium term,
they sell you out at a loss.
They sell you out, and you never get to be right. Because one of the interesting things about long-term capital is that those trades turned out, almost all of them, to be the right pick, but it took forever. And by then, they were bankrupt.
Well, coming up, we are going to talk to the boss of DV Trading. Now, this firm does more than 5 million futures contracts a month. Their volume is higher than the entire Montreal Exchange. Dino Verburgge, president of DV Trading, is next. To Alternative Investing. I'm here with David Kaufman of Westcourt Capital. We are, of course, talking about options and futures trading. We have Dino Verburgge of DV Trading here with us. Great to have you here, Dino.
Thanks for having me.
What does DV Trading do? Tell us a bit about yourself and DV.
Well, I've been a derivatives trader now for, I guess, just a little over 10 years. First 5 years with a large U.S. broker-dealer, spending a lot of time in the UK and then back here in Canada. The last 5 years, in January of 2006, we founded DV Trading, where now we trade pretty much every asset class in all the major exchanges here in North America and in Europe.
You just trade for your own account, though? You're not selling a fund to anyone?
Correct. We just trade the firm's capital. There's no outside capital. There's no fund. We just trade our own capital.
At the top of the show, we identified what options are, what futures are. How do you use them, and which do you prefer to use in a larger scale?
The majority of our strategies are built around trading futures. We do have a number of traders and teams of traders that deploy option modeling strategies and deploy them as such. But our primary focus is definitely always been and will be futures.
Why is that? Just the enormous leverage, or?
It lends itself very well to the strategies that we deploy, and of course the leverage is quite large as well. Yes.
Okay, so speaking of using leverage and a strategy to deploy, we talked a little bit already about that you can use these instruments either to make directional bets or to hedge oneself. So let's talk first about if you want to make a directional bet, you either are bearish or bullish on the future of some security. Can you explain exactly how you use options and futures to make that directional bet?
Sure, absolutely. There are a number of ways in which you can express a directional view using futures and options. But I'll just give the.
When you say a directional view, for example, you might think gold is going down.
Yes.
That would be a directional bet.
Correct.
Okay, sorry,
correct.
Go on. Yeah.
Or another example would be if you have a portfolio full of stocks that you're generally long, which is the majority of people out there. You could. And you don't feel like selling any of your holdings, and you feel that it's overbought in the short term, you could express your bearish view in a short-term manner by buying some downside puts, or you could carve out a certain notional amount of your portfolio and sell a highly correlated stock index future against your portfolio as well. The reason why I like downside puts is other people refer to as out of the money options is because they're cheaper and they allow you more leverage.
And as the stock weakens, you don't have to exercise the put. It's likely to go up in value in the market.
Absolutely.
Yeah.
So if you think that the correction that you anticipated, which then in turn occurred, is now also overdone, then you can exit your option trade quite easily.
You have a provocative thing here I want to share with the viewers. You reckon real traders don't buy stocks?
No, I disagree, but I think it's very difficult to especially in these economic times and geopolitical times, know where the market is going. So the money in which we earn, we generally don't invest in stocks for the long term.
Because you're tying up capital. Correct.
Yeah, so what you're indicating there is that you don't necessarily want to have to predict exactly which way the markets are going. You want to profit in either direction, which is really what absolute absolute return strategies are all about. So can you explain how it is that you use relative value trading to get an absolute return on an annual basis?
Sure, and specifically how it relates to or how you can use futures or options. Futures tend to lend themselves quite well in the example I'm about to give. Let's say that a very easy example to understand. You think that silver is relatively overbought in reference to gold. So you find out the notional amount at which you are dollar neutral. You can sell silver future contracts against gold contracts. And over time, if you are right, then the prices will diverge and you will make money.
So you'd go long silver. You'd go short silver. You'd bet on silver going down.
Correct.
And gold going up.
Correct.
And as things revert to the mean, the normal ratio 50-55 silver to gold, you'll make money.
Correct.
And you don't really care whether precious metals as a whole go up or down here.
Absolutely. That's the heart of a lot of strategies that we like to deploy. Because we find that it's easier to find quantitatively models or relationships that revert rather than trying to get the overall direction of the market right.
Now, reversion or any market moves could happen over years, could happen over months, but we also know it could happen in seconds or even microseconds. Mm-hmm. Can you define sort of high-frequency trading compared to medium-frequency trading, which it is that you use, and how that works?
High-frequency trading is a means by which you are transacting by trying to profit off of the smallest amount of available increment in the market as many times as possible, usually resulting in thousands, if not millions of transactions in a day. The high-frequency traders are typically comprising anywhere between 30 and 50% of the overall volume of the market.
Wow.
Usually they're completely 100% automated, have servers right at the exchange, and they are pure arbitrage or statistically in nature, the strategies themselves. Medium-term or medium-frequency trading would be also statistical in nature, but just have a longer time frame in the expectation of the profit of the trade.
I just want to touch on one thing you said. You said that they have servers at the exchange. Do you mean that the physical proximity of the server to the exchange matters in high-frequency trading?
Absolutely.
We're getting into quantum physics.
Yes. Explain.
Well, it's become an arms race. Not only do you need to be close to the exchange, you need to have the fastest routers. You need to have the fastest hardware. You need to have the fastest software. You need to have the best developers to constantly tweak and enhance your software. Where in that field, it's no longer measured in milliseconds. It's actually measured in microseconds.
Stock exchanges exist for a reason, and I don't think that they were invented to facilitate high-frequency trading in microseconds and milliseconds. What is generally the view of high-frequency or even medium-frequency traders in terms of how it is that they affect the market and how they affect actual people out there that are buying and selling boring old stocks?
Well, I think it's mixed. I think a lot of people like to have or like to lay blame when things aren't going well. But overall, I would say that high-frequency traders provide a significant amount of liquidity in the market. If you look at the stocks these days, the spread between the bid and ask are significantly tighter than it was 4 years ago.
Well, that's good for even regular investors.
Absolutely, it is. It absolutely is. Are those bids and offers there to stay? If you want to cut through every single price, probably not. But if
so, does that you mean are they feelers? Is that what you mean?
They're feelers. Well, they wanted that price. If other factors of their strategy are also in line, if those change, then they're going to move their bid or offer.
I got to ask you that. Who's the personality type that does best in options and futures? Is there a type?
I don't know if there's necessarily a type so much as you need to be reasonably intelligent. You need to have a mathematical and statistical background. Nowadays, it definitely helps to have a computer programming background as well.
Wow. It's become that computer linked now.
Yes, absolutely.
But what about good old-fashioned resilience, but also discipline? Because I presume that you want to avoid the cautionary tale of long-term capital management, and you want to close out positions that are going in the wrong direction.
Absolutely. discipline is definitely a factor that you need to implement, not only as a person but in your models, in your trading logic. And discipline just means trading 101. You need to have a defined stop loss before you just get out. Whether it's a directional bet,
walk away.
Yeah, whether it's a directional bet or if it's a relative value mean reversion trade, you need to have a defined stop to know when you're going to get out.
Okay, let's use a real-world example, which is especially relevant in the last couple of weeks as we see what's happening in Libya and Egypt, the Middle East, and now Japan, about how someone can use options or futures. So I know that you've put an example together for us regarding oil. So let's say that you are bullish on the price of oil in the next 6 months. You think oil is going to go up. Can you explain how someone could best profit from that using options or futures and what the relative risk would be?
Yeah, there's many ways. First of all, you can get into call spreads, put spreads. You can get quite complicated, taking advantage of backwardation or contango in the oil curve. But in the most simplistic form, you can either buy calls or you could also sell puts, but also just buy the futures contract. If you buy calls, I would recommend buying upside calls because, again, the leverage is inherently larger, which gives you more bang for your buck, and you end up with a better return. However, with that comes more risk. You could definitely lose all of your investment. So if you are going to be betting on the market using upside calls, then make sure that you only allocate a small percentage of the cash that you're willing to invest.
Well, coming up, Dino is sticking with us. Dino Verburgge, president of DV Trading. We're going to ask him how you can use options and futures in times like this, when you've got all kinds of turmoil in the Middle East, or when a crisis like the earthquake in Japan occurs. After the break. Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital, and of course we've got Dino Verburgge, president of DV Trading. I'm just sort of thinking about, the human tragedy in Japan. Obviously, they're going to need an awful lot of rebuilding. Now, you've been talking about profiting off mispricing of options, discrepancies. Mm-hmm. Take copper. Mm-hmm. Copper, the commodities complex is down, but they're going to need a lot of copper in Japan to rebuild. Mm-hmm. So is there a time-based way you could play discrepancies there?
Yeah, absolutely. There's a number of ways, and that's a very good example, actually, one that I was thinking of this morning as the event unfolded. If you want to be long copper, then you can literally just, again, I hate to harp on the same topic, but you could buy upside calls. And just buy longer dated ones, knowing that this is going to be a long rebuilding period. It's going to cost more because there's more time value inherent in those options, but that is one way to do that trade.
So the trade-off there is that you pay a little more because you have a lot longer time to be right in.
Correct.
You could be wrong in the short term, but as long as you're right in the long term, you win.
Correct.
Okay.
And obviously there's the copper futures listed on various exchanges in the world. But predominantly on the CME, obviously, and you could be just going long contracts in the copper futures.
Can we just talk briefly about copper, because it's such a crazy market. Copper's near record highs. It's sold off today. What's it been like trading copper over the past few months?
Copper, like a lot of the commodities or metals, I should say, have been a bit of a wild ride of late. Copper, which is more of a base metal, has taken a hit recently. A lot of that is attributed to China's intent to slow down. India has shown signs of inflating. So there is some concern that the story of the developing nations really acquiring a lot of these base metals slowing down considerably.
Let's switch over from metals to oil, which everyone in the world needs, and every event, it seems, irrespective of where it happens across the globe, can impact the price of oil. Would you think that tell us about what you're thinking about oil? Is it more important to be able to guess which direction it's going, or know how to profit from the volatility that happens when all of these events unfold across the globe?
Right. There's two ways, like you mentioned, to profit off of big movements in oil. It is obviously quite difficult to get the timing right of when oil is going to go up if in fact you are bullish especially right now with the huge relative builds at Cushing, which is the delivery point of the main crude contract in the world.
Backed up there's tens of millions of barrels. It's insane. Yeah.
Yes, agreed. And that's causing the Brent WTI spread to widen out to levels we've never seen, or at least I've never seen. You could, if you want to just profit off the volatility, you could buy straddles, you could buy strangles. And when you do such, you will make money. If you think that volatility is cheap and you buy a straddle or you buy a strangle, then you will make money if volatility increases, regardless if the price goes up or down.
Give us a quick definition of a strangle.
Yeah,
you're buying a call and buying a put, and with a strangle, you're buying a put at the same, and you have to do it the same strike with the same expiry, both at the money options usually. Whereas a strangle is
or straddle.
I defined a strangle first, and I'm sorry. Straddle is the first one. Strangle is you're doing it with upside and downside puts and calls. So again, you're buying a call and buying a put, but you're doing it with out of the money options.
As complicated as all of that may seem, in the end, it's always all about, if I'm hearing you correctly, identifying the cheap asset, identifying the expensive one, and buying the correct one, selling the correct one, so that in the end you can profit on the difference. But that's nonlinear, right? Because the most you can make is the difference, but you could lose an infinite amount. Is that right? If
you're trading volatility, it's a dangerous game because a lot of people like to sell volatility, and if you sell volatility, the potential losses are almost unlimited.
So you ride options, you get a big fat premium,
yes,
but you can just get murdered.
Absolutely.
David,
absolutely.
We're almost out of time. David, go ahead.
Well, what I'd like to know is a lot of people at home are probably wondering whether they're able to execute any of these strategies at home. Can they?
Absolutely, they can. It involves a lot of research, a lot of time, and understanding of the relationships between commodities and between different instruments and between different markets. But I say that with caution because the amount of cost involved to get the analytical tools, the research tools, the software applications that we use is going to cost the individual hundreds of thousands of dollars a month.
Wow.
So that would be probably pretty difficult for the average person to absorb.
But that doesn't mean that they can't at home use options and futures in order either to profit or to hedge in a much simpler way, right?
Absolutely, absolutely. And in fact, most local broker dealers give you access to all the same markets that we trade, and they definitely, any viewer at home can trade the same markets that we trade. It's difficult to get your hands on the same sophisticated trading applications and research tools without spending the money.
Okay. We'll have to leave it there. Fascinating stuff. I hope you'll come back, Dino.
Thank you.
Dino Verburgge, and he's the president of DV Trading. Thanks to you, David Kaufman of Westcourt Capital. We are out of time on alternative investing. We love to hear your suggestions, your feedback. Alternative investing at bnn.ca. Get your questions in, and we'll see you next time at 11:30 Eastern, 8:30 Pacific.